Well, welcome back, ladies and gentlemen, to Green Impact Partners channel, strategically positioned to lead the transition to a green and sustainable economy. As always, joining me is the Chief Executive Officer, Jesse Douglas. Welcome back, sir.
Great to see you again, Kyle.
I always love having you back. So this time around, we last spoke kind of about the revenue side of the business, and I think it's really prevalent because I really feel like you guys are almost trading at a discount, but I'll speak more about that so we don't cross any SEC regulations, of course. But let's talk about the balance sheet a little bit, because this is kind of incredible in my opinion. You guys got a robust $162 million in assets, which $27 million sit in cash against a current liability of only $19.4 million, which just seems a little nutty to me because you guys are almost trading from an asset standpoint after those liabilities, more assets than your current market cap valuation. But we won't get too much into that, but do you want to talk a little more about kind of the cash spend, how you guys are utilizing that cash, and any further insights into the balance sheet you think are prevalent?
Yeah, absolutely. I mean, ultimately, we really don't have any debt. What you see for the 19 million there is kind of our current liabilities on the flow through from our assets in the operations of them. So those are just kind of our payables that move through as we collect them. Certainly, our working capital is robust, and our non-cash working capital covers that. So we don't need to dig into cash in any way to cover what that liability set is. We are debt free at this time. And what we're using our cash for is to continue our clean energy development portfolio. And so what you should expect from us is that every dollar we're deploying there, we expect to be seeing that back in the range of 2 to 3 years and on a continuous, generally contracted level. So, I mean, we agree with you completely when you say that it seems like we're trading only for our asset value. I think we are trading for less than our asset value today. We are trading at only a couple of times multiple to future earnings, predicted future earnings on the facilities that are completed and the existing facilities that are operating. And we think it's somewhere between 10 and 50 times lower than anyone else in our peer group right now. So we've got a pretty robust strength to our balance sheet. We've got great cash. We've got plans for that cash. It's not sitting there idle. And we are continuing to grow revenue and bottom line earnings quite substantially every year.
Yeah, and as we spoke, as you guys kind of start to build out some of those margins, do you want to talk a little bit about the capital structure side of this business? Because I noticed in the past you guys did do some share dilution. Is that something you might consider in the future, or are you guys going to step back a little bit from that, focus more on value propositions? Any insights there?
I don't. I mean, at today's share price, I would see us. We have no need to raise cash. We have access to cash. We have access to sell partnerships and facilities. We can raise without losing control of any of our facilities. We could raise $600, $700, $800 million this year if we needed to deploy that much. So we don't have a need to go to the markets and raise any money through the dilution side of things. But I feel like if the markets were trading us at what we believe we're worth, we probably would use that. If that becomes our cheapest source of capital, then that's what we would do. I mean, we've got substantial insider ownership. We've got some great long-term shareholders in large semi-permanent funds that are with us. And we're loyal to doing what's right for our business. That's there. We're here to make an environmental impact. We're here to do it profitably. We're a for-profit business, and we're certainly not going to needlessly dilute any shareholder at any point. And so I wouldn't expect to see us come to the markets right now. And our internal analysis says that we would be really unlikely to come to the markets at $50 and only kind of likely at 100 based on what we think our assets are worth.
That's great to hear. I really appreciate these insights, and hopefully the retail audience appreciates it as well. Thanks so much, Jesse.
Thank you. Talk to you soon, Kyle.
You as well. On that note, stay cool, stay awesome, and we'll catch you in the next one.